Peter Thiel was in the news recently for growing his Roth IRA from $1,700 all the way to $3 billion. And he used some simple strategies and techniques that you can use as well. My name is Nathan Crampy, and we want to be discussing those strategies and how they can benefit you, your family, and the community that you care about. But before we do that, let's look at the dynamics of a Roth IRA and why they are so beneficial. Now, to look at the dynamics of the Roth IRA, we have to look at the dynamics of all types of accounts that you could put your money into. There are three distinct types of accounts: your tax-deferred accounts, your taxable accounts, and your tax-free accounts. Tax-deferred. Now, what is that? Those are the retirement accounts that you have that you can be putting money into. They're going to grow tax-deferred, so the money that is in there right now has never been taxed. And in retirement, you can take that money out, pay a little tax on it, and use that for your income. Well, those are what we traditionally know: a traditional IRA, a 401k, your 403b, deferred comps. All of those are in your tax-deferred bucket. Well, we also have your taxable account as well. Now, that one is your individual account, your jointly held account, brokerage account, investment account. They all have different names, but they're the same concept, where they're taxable in the year that you have, dividends, income that you've received from there, trades that have been placed. All of those can be subject to tax, which makes it a taxable account. So we have the tax deferred that's never been taxed today, but will be taxed in the future. We have the taxable account, and we have the tax-free account. That is the Roth IRA. The money that is placed into there is after-tax money, but then it grows tax-free. Well, how did Peter Thiel turn his into $3 billion? How did Warren Buffett turn his Roth IRA into hundreds of millions of dollars, when the average that you and I have in our Roth IRAs and all Americans are around $39,000? How did he do it? Well, that's where it comes down to the strategies. Let's dive in and talk through them. Strategy number one, very simply, put money into your Roth IRA account. Now, the government wants to make sure that this money is growing, that you can utilize this money in the future, and it's a good way to save. They did not want to give you that good of a deal, though, as well, because they didn't want you to put unlimited amounts of money into these accounts. So what they did is they put a cap on the amount of money that you could put into the account. On a yearly basis, today, you can put in $6,000. And if you are over the age of 50, you can put an additional $1,000 into the account. Now, again, that's a limitation, so you can't put more than that in. There's a second limitation as well, that you have an income cap. If you make too much money, you cannot put money into the Roth IRA as well. That cap is $198,000 into 2021's dollars, and there's a scale where you can go up to about $208,000, and if you're within that range, you can put some money in. If you're underneath the $198,000, you can put in the full $6,000. However, anything above it, you are unable to put money into the Roth IRA. There are those income limits, and those are the married filing jointly. But for many of you, you will be able to put money into your Roth IRA and take advantage of this on a yearly basis. That's the number one way you can put money into that tax-free bucket for the future. Strategy number two. This strategy is what Peter Thiel employed. And simply, this one is buy investments that are going to appreciate quickly. You see, Peter Thiel was the co-founder of PayPal. And what he did was he bought a certain investment that would, and for what he understood, could grow very fast, very quickly. Now you can do the same as well. And even though you may not have a new startup like PayPal that you could buy in your Roth IRA, in the case of Peter Thiel, he bought 1.7 million shares of PayPal, which was not a public company at the time. He bought it in his Roth IRA as being part of the founder, and he paid 1/100th of a penny for each share. So that amounted to $1,700. Now, even though you cannot do that for the most part in your accounts, there are many other types of investments that you may be able to purchase that meet your risk objectives, things that you are wanting of your account that may grow very fast. Well, this strategy is not for everyone, but if this is one that you employ, the correct investments could turn your hard-earned money into a good chunk in the future. Which leads us to strategy number 3, Roth conversions. Now, Peter Thiel put some high-flying investments in his account, but Warren Buffett used this as his ability to put more money into his Roth as well. You see, when we come back to those buckets, what a Roth conversion is taken from that tax-deferred bucket and transitioning it, paying a little tax on it, and putting it into the Roth IRA account. So Warren Buffett paid tax on the money going from his, at that point in time, his traditional IRA or 401k into the Roth. Now, he did some other unique things of using some tax loss harvesting or some other ways to offset some of those gains so that he did not have to pay an exorbitant amount of tax on this. But what he did is made sure that he had money that now could grow tax-free. You can take a look at that strategy as well. And when you have money in your IRA account, you can convert, so that would be transition some money from the IRA, pay tax in the middle on this much money, and put it into your Roth IRA to grow tax-free in the future. A great strategy to employ, and one that I would want you to consider after you have done a tax map or a tax planning on where you're at today with your taxes and where things potentially could be when you do conversion. That leads us to strategy number 4, the backdoor Roth. Now, this is one that if we look at all of the unique characteristics that we've talked about so far of the Roth IRA, for many of you who are business leaders high up in your corporation, or even if you're newly started in your career path but have a lot of income but not a lot of savings, this is a strategy for you. Now, what this one does is say it's a way to put money into the Roth IRA and get around, using the back door, those limitations, those income limitations. So I talked about the $198,000 for married filing and jointly, those modified adjusted gross income that you need to have and be under to put the full $6,000 in. And if anything that I just said was Greek to you, I have other videos that will help explain what your modified adjusted gross income is and making sure that you know where you're at so that you can put in the full amount. Now, like I said, if we're underneath those limits, you don't have to worry. If we're over those limits, you do not qualify to put money into the Roth just on an ongoing basis. That's where the back door comes in, and we can put money into the traditional IRA. Now, this is something that the traditional IRA is tax deferred, but generally put money into it on basically a manner that is not taxable. So we put money into there and it can grow tax-free. Whether we take the deduction is what we get for putting money into there. But what if we don't take that deduction? What if you don't qualify for the deduction? So again, if you're over that $198,000, chances are you don't qualify for the deduction of the traditional IRA. Now here's the thing, if you don't have an IRA, this is a very, very good strategy because we have to put money into it on a non-deductible basis, meaning you do not get to take the tax benefits of putting money into that account. What we can do then is say the money that goes in there, so the $6,000 for you or another $1,000 with the catch-up, we can convert that right away and put it into the Roth, and no tax would be owed if you do this correctly. Now again, this is where making sure you look at your tax situation and how to do this correctly is going to be very beneficial. But if you do not have the traditional IRA, you can put money into a brand new one that is non-deductible and convert it, and we don't have to pay tax. And those are some great strategies that you can learn more about the backdoor Roth and how it can benefit you so that you too can put money into the Roth even if you're over those income thresholds. Strategy number 5 then is taking money from your 401k and rolling it over into your Roth IRA. Now this is just like the Roth conversion, where we're taking money from an account that has never been taxed, we would pay a little tax on it, and then we would be putting money into the Roth. So that is a strategy again that you have to use the tax maps or your tax planning to make sure you know where your taxes are going to be for this year and how much you can put into the Roth and still be beneficial for what you want to do. There you have it, 5 strategies that you can employ for putting money into the Roth IRA and fast-tracking your ability to be just like Peter Thiel, Warren Buffett, and many other billionaires, and how we can continue to keep growing your tax-free buckets. Now, there are some strategies you can use, obviously, to reduce your tax liabilities on a yearly basis. Something called tax loss harvesting can be very prudent, and things that you should be looking into as part of your tax map, or again, tax plan, as I like to call them. Now, one bonus strategy. If we want to reduce taxes, there are many opportunities that you have, especially as a business leader, to do that. But what if we can't? What if we are going to do a Roth conversion to put more money into the Roth IRA and take it out of that taxable bucket? Well, again, we have to pay money today to taxes to make that happen. Well, where does that money come from? One strategy you may employ, and again, this is something for you to consider as part of your own personal wealth plan, maybe to take money out of your permanent life insurance policies and use that as a loan to pay for the taxes before it goes into your Roth. Now, what that would do is be able to convert the maximum amount from your IRAs into the Roth. The taxes would come from your permanent life insurance policy, and if done correctly, the loan may grow still as part of the plan, so that we're able to have the growth, we're able to continue to keep growing the plan in your policy, but we can now pay back that loan over time. And again, if done correctly, we may be able to use the Roth IRA and some of the money in there that's been growing to pay that back. So now what we are able to do is use money from your permanent life insurance policy that may not be subject to tax to pay the tax. We can use the tax-free growth that's been happening in your Roth possibly to pay it back. And what that would do then is obviously help to make sure that you can grow your tax-free buckets and pay the least amount of tax possible, making you able to transition more money into those Roths over time. For many more strategies that you can employ and how to continue to keep working your wealth, and especially into that tax-free bucket, click subscribe on the video here and you'll learn more about some upcoming opportunities that you can take advantage of with your wealth. Now, the idea of your wealth is to bless your family, bless your community, bless those you care about, and leave a legacy. With that, I call that creating a wealth impact or wealth pact. Own your wealth pact.